Good morning, friends. Shawn.Kaplan here, Legacy Mutual Mortgage and the Kaplan team with another Friday Fuel Up where we take you from 89 octane to 93 octane with a little sales or a financial tip. So today, I want to talk to you about the 3 C's, qualifying for a mortgage loan. You know, I got a lot of friends and clients in discussions, they'll say, what's it take to get a mortgage loan these days? You got to put 20% down? Do you have to have perfect credit? Am I allowed to be self-employed? And the answer is actually yes, you can be. You don't have to have perfect credit and you don't have to have 20% down. And you know what? It's become apparent to me that there's probably a massive amount of people standing on the sidelines, especially in Nashville, thinking, I can't buy a home right now. And don't listen to that until you know for sure or talk to a gentleman like me. So what are the 3 C's? I've been teaching this for about 10 years. I like things in bullet point format and simple. And I'll go ahead and have Will put this up on the screen. But the 3 C's are basically credit, capacity, and collateral. I call it that. This is what I came up with to explain to my clients. But the official name is the Dodd-Frank Act of 2010. And that's what was passed after the economic housing collapse of 2009 to protect the economy and give the mortgage industry uniform standards around qualifying and documentation. So this is why no matter what bank you go to, it's pretty much all going to be the same documentation. It's all pretty much going to be the same interest rate and the same costs. You're protected, but it's going to boil down to expertise and communication, in my opinion. So first C, credit. So that's, you got to have a 580 credit score and you want over 740 if you want the best interest rates, but you can go down to a 580 credit score. Capacity. I'll look at your income. I'll talk to you about your income documents, which is why it's so important to get all of it to a lender. And what we will do is we'll figure out what is 50% of that provable income. And that's what we can use towards a mortgage and other debts and liabilities. And that's how I'll reverse engineer to figure out how much you're pre-approved for before you get out there and look at houses. Key word was before. Collateral. All right, collateral is the property. Look, nobody wants to loan you money on a piece of junk. You know, I don't mean to be offensive, but you can't buy a dilapidated, renovated fixer-upper with no windows. Mobile homes are really difficult to qualify sometimes. Large pieces of land, some condos. So it's very important we also know what type of property you're wanting to buy, or when you go to make the offer, make sure with your lender that it fits your financing. These are the 3 C's of qualifying for a mortgage loan. It's not magic, folks. It's actually not as hard as most people. So don't sit on the sidelines and let the fear of no keep you from buying a home and building wealth and paying off debt. Hey, click that like button if this was helpful, okay? And give me a thumbs up or something in the comments. And if you feel compelled to share this post with other people, please do so. It's my job to go out there and educate the world and help people pay off debt, build wealth, and become homeowners instead of renting. Shawn.Kaplan, Legacy Mutual Mortgage. Make it a great Friday.